AI fever. Everyone's got it. Companies have committed to spending a staggering $2.1 trillion, yes, trillion with a T, on AI development by 2027. To put that in perspective, it's more than Canada's entire GDP. But here's the catch. Vanguard, the behemoth money management firm, just released detailed analysis that suggests the net present value of AI could actually be negative. What the heck does that mean? And if AI is just a huge bubble waiting to burst, where should you be investing instead? In this video, I'll break down Vanguard's projections for 2026 market in great detail. I'll weigh in on what seems sensible and what I respectfully disagree with. I'll also share the key asset classes I believe could vastly outperform AI stocks in the coming year. Before we keep going, you might be wondering who I am. Well, my name is Steve Reitmeister, and I've been investing for over 40 years. I was previously the editor-in-chief of Zacks.com, where I educated millions of investors. Now I'm a partner at WallStreetZen.com, where I help develop a quant rating system so investors can find the best stocks fast without any of the BS. Now it's time for a heat check on the AI industry and to look at what Vanguard has to say about 2026 market and the AI stocks. Now, that $2.1 trillion number I threw out earlier wasn't just random speculation about how much companies might spend on AI. It's based on actual documented commitments from big names like Amazon, Microsoft, Google, Meta, Tesla, Nvidia, Apple, Oracle, and the like. It makes sense. Every major technology revolution requires massive capital up front. Railroads in the 1850s, telecom and the internet in the 1990s. With AI, we're only at about the 30 to 40% mark of where the peaks hit. That indicates the biggest spending is still ahead. Vanguard asked the critical question, will these companies actually make their money back on these massive investments? They calculated the net present value across different scenarios. The baseline scenario, the net present value or NPV, is negative 0.9 trillion. But if these companies have weak competitive moats, meaning competitors can copy their approach, the NPV drops to negative 2.7 trillion. The only scenario where this works out well is for companies with strong economic moats and cheap capital. Even then, the margins of these investments are razor thin. So why are they doing it? Two main reasons. First, it's an arms race. If Microsoft is going to spend $50 billion, Google must match it or risk irrelevance. They're forced to spend even if the collective returns are terrible. Second, creative financing, leasing arrangements, private credit deals, vendor financing, anything to keep it off the balance sheets and maintain the earnings growth story. That's the problem here. Markets expect endless earnings growth. So spending $2 trillion and earnings flatten would lead to cratering stock prices. To be clear, I don't disagree with Vanguard's net present value analysis. The math is sound and the risk is real. But here's where I differ. I'm not ready to completely abandon tech and AI stocks just yet. That's because my approach is what we call GARP, growth at a reasonable price. There are still fundamentally strong tech companies with reasonable valuations if you know where to look. The key is being selective, avoiding vastly overvalued stocks like Palantir and Snowflake. Instead, let's focus on companies with consistent earnings growth, strong balance sheets, and valuations that actually make sense in the real world. By the way, if this resonates with you, go ahead and hit like down below so I know to make more videos like this one. Here's what breaks most people's brains. Vanguard is actually bullish on AI transforming the economy. They see a 60% chance AI pushes US GDP north of 3%, the strongest sustained growth in decades. Yes, this all sounds quite confusing, that AI transformed the economy, but AI stocks suffer? The pattern has a name. It's called the infrastructure paradox. Let me explain. Phase 1, builders get all the attention. Phase 2, infrastructure gets commoditized. Phase 3, users capture all the value while infrastructure players are left holding the trillion-dollar bill. Here's how it played out before. Let's consider the 1990s internet boom. The internet absolutely transformed everything. E-commerce, remote work, you name it, it transformed it. Phase 1, Cisco, SunSystems, Lucent, they built the infrastructure. Stock prices were parabolic. Cisco hit a $550 market cap. Phase 2, the infrastructure gets commoditized. Competition presses down prices. Most builders disappear. Well, let's say Pets.com, Webvan, eToys, you remember? They're gone. Cisco crashed 89% and it took 17 years for the price to recover. All right, phase 3, Google, Amazon, Facebook, Netflix, companies that used the infrastructure but didn't build it. They captured all the value. Most didn't even exist before the build-out began. We're entering phase 2 for AI, whereas most investors are still betting on phase 1 winners. A change is already afoot. Case in point, early 2025, a Chinese company called DeepSeek released an AI model at a fraction of the cost of major major U.S. competitors. Nvidia dropped significantly in a single day. Investors suddenly realized that maybe you don't need $100 billion in GPU spending to build cutting-edge AI. Creative destruction in real time means that phase 2 has already begun. Before I keep going, I want to share something else that's forward-looking. I've identified 3 stocks I believe could double in the coming year. Click the link in the description below to get those tickers for free. Now back to our regularly scheduled programming. Most analysts on Wall Street think Vanguard's thesis is insane. To them, looking at the value stocks during an AI revolution is kind of like buying a horse carriage during the automobile boom. I get it. Every financial channel shows Nvidia going parabolic. Your cousin made 300% on it last year. The momentum is undeniable. But Wall Street forgets those charts from 1999 look just as good. Cisco was different this time. Sun Microsystems had unbeatable technology until they weren't. The question isn't whether AI is transformative. Everyone agrees it is. The question is, will today's AI companies be tomorrow's winners? History says no. Not all of them. So what will win tomorrow? Well, let's dig in. First, let's consider what's happening right now. We're coming off a robust earnings season. Analysts are raising estimates for future quarters. The full-year outlook is about 8% growth for the S&P 500 earnings going forward. Not gangbusters, but solid growth. The economy is also on track. Plus, the Fed just lowered rates. And as they say, don't fight the Fed. That's a bullish catalyst for 2026, even if the long-term picture is more nuanced. So while I agree with Vanguard's 10-year view, I think 2026 itself could surprise to the upside. This is a great year for active stock pickers who can navigate the rotation from mega caps to quality growth and value stocks. So what does the smart money do instead? Vanguard analyzed every asset class by risk-return profile over the next decade. Let me count down 3 of their top picks, then offer my commentary. Number 3, international developed market stocks. Europe, Japan, developed Asia, much lower valuations because they haven't priced in all those AI productivity gains. These international companies will be consumers of AI. This is where we'll see the impact of cutting costs, boosted efficiency, improved margins without spending that $2,000 to build it out, or the phase 3 winners before phase 3 starts. The 10-year return forecast is looking like 7.2% annually. So the number 2 group that Vanguard points out is U.S. value stocks. Industrials, financials, consumer staples, energy, the stocks most people call kind of boring. These are stocks trading at reasonable valuations. They'll integrate AI into workflows without massive capital expenditure risk. Plus, they provide a hedge if the AI boom doesn't materialize as expected. The 10-year return forecast is to gain 7.8% annually as we move forward. And number 1, high-quality bonds. Yeah, bonds. The neutral interest rate is now 3.5% to 4%, much higher than the past decade. High-quality bonds return above 4% annually with very low risk. After inflation, that's of 1.5% to 2% real returns. U.S. stocks, on the other hand, 4% to 5% annually, but with massive volatility. Plus, if AI investments fail and markets crash, then bonds rally, providing solid returns and downside protection. So what about U.S. tech stocks? Vanguard forecasts only 4% to 5% annual returns over the next decade. Pretty lackluster after all the outside gains in the past decade. Okay, Vanguard and I really part ways with this list. Bonds at number 1? Okay, I get the math. I understand the neutral rate argument, but I'm not putting bonds at the top of my investment list for 2026. Here's my take. Yes, we're nearly fully valued for large cap stocks. Yes, the easy gains are behind us, but we're still in a bull market. Bull markets last on average 63 months, and yet we're only 38 months into this since the October 2022 low. There's more room to run. My S&P 500 target for the coming year is 7,500, which aligns with much of Wall Street, but I'm not getting defensive yet. I'm focused on quality growth at reasonable prices. That skews to small and mid-cap stocks where they are trading at massive discounts to their large-cap peers. Look at this. Small and mid-caps would actually have to rally 40% just to catch up with the valuations afforded to their large-cap peers. That's the opportunity. Not sleepy bonds, but undervalued quality stocks. Now let me show you how they're actually putting this into practice. Now, this may piss off every tech bro on Twitter, but look at how Vanguard is positioned for the future of AI, and the first thing you'll notice is what isn't there? Where's the Magnificent Seven? And where's the big bet on AI scalers? U.S. growth and tech exposure comes in at just 6% expected gains over the next decade. Here's the full breakdown of their asset allocation. 40% equities comprised of the following: 15% in U.S. value factor, 12% developed markets excluding the United States, 6% U.S. growth factor, 5% U.S. small caps, and 2% emerging markets. Now, 60% of that money is going to be put into fixed income, divided up as follows: 27% U.S. aggregate bonds, 24% international bonds, 5% long-term treasuries, 2% short-term treasuries, 2% U.S. intermediate credit bonds. Let's focus into a few things here. 12% in international stocks that no one's talking about. 15% in U.S. value stocks everyone calls boring, and over half the portfolio in bonds. Now compare that to the S&P 500, where tech alone makes up over 30% of the index. This is not a portfolio optimized for squeezing out the best possible returns. It's a portfolio optimized to survive the next decade, assuming AI doesn't deliver on the hype. That's the point. It's a deeply defensive posture. My approach is different. I run something called the Zen Ratings, a quantitative model built on 115 different factors spanning financials, growth metrics, momentum, value, sentiment, and AI signals. From that system, I've built 11 distinct strategies. One of them is called Buy the Dip, designed to find fundamentally strong stocks when volatility forces temporary price pullback. In November alone, during a textbook volatility window, that strategy returned a whopping 22.6%. And over the last 6 months, it's up over 53%. That's not hypothetical because the results are from my actual Schwab account proving out the gains. Now, could Vanguard's defensive portfolio outperform over 10 years if AI disappoints? Absolutely. They may be exactly right. But for 2026 specifically, I believe there's a meaningful alpha available for investors willing to be more selective with quality growth and value stocks, not mere blind speculation. The difference is having a system that identifies fundamentally sound companies before they make their move. And you might be thinking what I thought too. If we're only 30 to 40% through this AI cycle, couldn't tech still surprise to the upside? Maybe the next phase is when it finally delivers. That's what I believed until I saw what the next phase actually looks like. Vanguard assumes a world where the AI hype cools, growth slows, and capital preservation matters more than the upside potential. A larger bond allocation, just 6% U.S. growth stocks, is exactly how you position for uncertainty. But here's the problem. We're only 30 to 40% through the AI cycle, and the most expensive part is still ahead of us. That's phase 2, and phase 2 is where things get wild. Phase 1 was broad and relatively contained. Software investments, equipment upgrades, some data centers. Spending was distributed and flexible. Phase 2 is the opposite. Imagine trying to power a city the size of Dallas, except the entire city is made of computers running 24/7. That's what AI phase 2 demands. This isn't software anymore. It's concrete, steel, copper wiring, power substations, and electrical grids that have to be rebuilt from the ground up. We're talking semiconductor fabs the size of small towns, data centers consuming more electricity than some entire countries, specialized real estate that must sit within miles of existing power infrastructure. These projects take 3 to 5 years to build, and they can't be financed with venture capital. On paper, the AI scalers can't afford it. Expected cash generation from 2025 to 2027 equals $2.4 trillion. Committed capital spending is $2.1 trillion. But the math only works in a perfect world. Perfect execution, no competitive threats, no margin compression, earnings growth like clockwork. If one thing breaks, these companies face 2 harsh choices: slash spending and fall behind in the AI arms race, or raise cash by piling on debt. Either outcome is brutal for stock returns, and this is where my real concern comes in. Going into 2026, the biggest risk isn't AI capability, it's not even valuations, it's employment. We're currently adding fewer than 150,000 jobs per month, not enough to keep up with the pace of population growth, and thus the employment rate is starting to rise. If that continues to sour in a meaningful way, it points to a recession and bear market. Here's the final risk nobody wants to talk about. All this spending assumes AI models continue improving at the current projected pace. place. If we hit a capability plateau, if scaling laws stop delivering, if these companies are left holding the most expensive stranded assets in corporate history, well, that $2.1 trillion in data centers that nobody needs, that's the scenario Vanguard is protecting against. Now you might be thinking, what if China wins the AI race? Shouldn't I be invested there instead? Here's why Vanguard isn't worried and why there's actually more bullish on the U.S. stock productivity than China's. First, let's be clear. China is moving faster than most people realize. The Chinese government is aggressively funding AI infrastructure. China leads the world in international AI patent filings and research publications. Its digital infrastructure, mobile payments, e-commerce, fintech is already world-leading and in many cases ahead of U.S. in deployment. So on the surface, China should see the biggest AI productivity boom. But here's what many analysts miss. Roughly 50% of Chinese jobs are in physically intensive industries, agriculture, manufacturing, construction. These are sectors where AI can help, but can't fully transform productivity. In the U.S., only 19% of the jobs fall into these categories. A much larger share of our workforce is in finance, professional services, and information technology, exactly the areas where AI can automate, augment, and scale human output the most. Then there's the demographics. China's working age population is projected to shrink by 30% over the next 25 years. Even strong AI productivity gains won't be enough to offset that kind of demographic decline. Vanguard's conclusion is straightforward. China may see faster initial AI adoption and a near-term productivity boost, but it hits a ceiling sooner than the U.S. because of demographics and industry composition. That's why Vanguard's portfolio overweights the U.S. and developed international markets while largely avoiding Chinese exposure. The demographic data is compelling, and on this point, I agree with Vanguard. When I look at corporate R&D spending, the U.S. is invested heavily in software and AI. Europe is focused on automotive and pharmaceuticals. China is investing in tech and construction, but remains behind in AI innovation despite rapid deployment. That distinction matters, and it's why over the long run, U.S. productivity and projected returns still have the upper hand. Quick aside, everyone's worried AI will destroy jobs. Vanguard looked at the data. Of the 100 plus occupations most exposed to AI automation, they are seeing higher job growth and higher wage growth than other occupations. AI is augmenting workers, not replacing them, at least for now. Okay, back to what this means for our portfolio. Vanguard isn't making a single prediction. They've mapped 3 completely different futures, and their portfolio needs to work in all 3. Scenario 1, AI stronger than expected with about a 10% probability. AI capabilities advance faster than anticipated. The productivity gains are immediate and massive. Economic boom, earnings growth over 8% annually, stock returns 8 to 10% annually. This is where being heavily in the Magnificent Seven and other AI stocks pays off big. Scenario 2, AI as general-purpose technology. This is a 60% probability and therefore Vanguard's base case. AI gradually transformed the economy over 5 to 10 years and productivity increases. U.S. GDP growth reaches about 3%, but it's a slow diffusion across many sectors. Earnings growth is solid at 6 to 8% annually, but valuations compress as competition intensifies and new entrants disrupt existing players. Stock returns only about 5 to 7% annually. This is where value stocks, international stocks, and bonds outperform growth stocks, and Phase 3 winners emerge. Scenario 3, AI disappoints with a 30% probability. The investments don't deliver meaningful productivity gains. Current AI is useful, but not really transformative, and that $2.1 trillion build-out was an overinvestment chasing a hype cycle. Earnings growth will suffer in this scenario at only about 3 to 5% annually. Valuations collapse as the narrative breaks out. Stocks return about -2 to +2% annually, including a likely bear market. This is where bonds, defensive stocks save your portfolio. The key insight: Vanguard's recommended portfolio is designed to work in all 3 scenarios. Note that I said work, not thrive. That's the very definition of hedging your bets, leading to tepid returns. Before you decide where to put your money, let me tell you a parable about the most valuable company that nobody saw coming. This story changes everything. In 2013, Nvidia was only the 380th largest company in the S&P 500. It represented only 0.5% of the index. They made graphic cards for gaming. That was about it. Yet in 2025, Nvidia hit $5 trillion market cap, the first company in history to reach reached that milestone. Staggering success, and early investors made generational wealth. But here's a lesson everyone forgets. In 2013, almost nobody saw it coming. Nvidia wasn't even building AI chips yet. The AI revolution wasn't even on anyone's radar. Again, they were just a gaming chip company. What does that tell us about the future? The companies that may dominate AI in 2035 might be small or unknown today, or they might be mid-sized companies in completely different industries that figure out how to leverage AI in ways we can't even imagine. According to Vanguard, there are 6,956 private AI startups that have received at least $1.5 million each in funding. That's more AI startups than there are publicly traded companies in the entire U.S. market. Some of those startups will be worth more than today's AI scalers. We just don't know which ones yet. And that's exactly why Vanguard is cautious on today's AI leaders. Creative destruction is real. It happens faster than people expect, and it's already starting. Remember the companies that built the internet infrastructure in the 1990s. Cisco hit $550 billion in market cap and was considered invincible. Sun Microsystems, Lucent, Nortel, they're either gone or mere shadows of their former selves. The actual winners? Google, Amazon, Facebook, Netflix either didn't exist during the 1990s build-out or were tiny companies using the infrastructure that others built. This is the infrastructure paradox playing out once again. Phase 1, builders dominate the headlines. That's where we are now. Phase 2, infrastructure gets commoditized. That's starting on. Phase 3, users capture the value. That's 2028 to 2035. History doesn't repeat, but it rhymes. I've been investing for over 40 years, so when Vanguard publishes research like this, I pay attention. The data is sound. On the big picture, the infrastructure paradox, creative destruction, overinvestment risks, yeah, I agree. But all these years taught me that this famed saying is true. Markets can stay irrational longer than you can stay solvent. Vanguard's 10-year view might be exactly right, but there's significant money to be made in years 1, 2, and 3, even if years 7, 8, 9, and 10 disappoint. That's why I run 11 different strategies based upon the Zen ratings. That's because different market conditions require different approaches. Right now for 2026, I'm leaning into these strategies. Buy the dips, small caps, value, and our AI factor model because that's what the data says will work in this environment. Am I ignoring Vanguard's warnings? No, I'm respecting them while recognizing that 2026 is a year for active stock pickers, not passive index investors and not for people hiding out in bonds. Let's bring this together with both perspectives. Vanguard's primary message is there are 2.1 trillion AI spending commitments. We're only 30 to 40% through the cycle with potentially negative 2.7 trillion net present value on those investments. Thus, best to go defensive in bonds, value stocks, international stocks, dramatically underweight tech. My message? The bull market has more room to run. We're only 38 months into this bull market cycle that lasts about 63 months on average. The Fed is cutting rates and earnings growth is expected to accelerate to 8% annually. Thus, it is best to stay on offense. The key is being selective, like focusing on quality growth at reasonable prices, avoiding small and mid caps, and buying the dip during any bouts of volatility. Here's where I agree with Vanguard. The infrastructure paradox is real. Today's builders may not be tomorrow's winners. Small and mid caps are massively undervalued. This is the best opportunity. Volatility is coming. 2026 will be choppier. Concentration risk is dangerous. If you are 50% plus in mega cap tech, you're making a bet with very low odds of paying off. Where do I differ the most from Vanguard? They are modeling for all three scenarios, including the 30% chance that AI disappoints. I'm planning on 2026 being a good year for active stock pickers, navigating the rotation from mega caps to quality growth and value in smaller firms. Both approaches can be right. It really depends on your time horizon. The worst thing, ignore both perspectives and stay 50% in mega cap, tech, in AI stocks because AI is the future and valuations don't matter. That's the most dangerous position, like those who were overweight .com stocks when the bubble burst in 2000. Think critically about portfolio construction, about concentration risk, about valuation. Have a system, whether it's Vanguard's framework or my Zen ratings, that helps you navigate what's coming next. Because here's what we both agree on. The next phase looks completely different than what got us here. I've linked both the Vanguard report and information about the Zen strategies in the description below. Read them both and decide which approach best fits your situation. What do you think? Are you positioned for the AI infrastructure paradox, or are you overly concentrating to today's AI leaders? Just drop a comment below. I generally want to hear your perspective on all this. If you want more insights that you won't find in the mainstream financial media, the kind of analysis that keeps you on the right side of the market action, then subscribe to this channel. And if you like this video, then check out my video that follows sharing 3 undervalued stocks I believe could power the next phase of the AI revolution.